Welcome back to the channel. We're going to be going over something a little bit differently. Typically, we're covering the stock market, exactly how we're moving and things like that. I want to make today's video going over how the housing market is moving and where I see it going, kind of a dedicated video for this subject. I've had a lot of questions about this as well. So let's not waste any time. Like, subscribe, do what you got to do. Let's get to it. So the first thing we're going to do is look at the Zillow statement, and this is from their earnings report. It's around a month old, give or take. But this is where things really started to shift in the minds of a lot of investors. So over the past year and a half, Zillow and Opendoor, if you don't know, really just changing the way retail buys homes. But their forecast has been shifting, and it's been very much on the demand to the upside. However, this was the first time that they've shifted from that stance of continuous growth to a slowdown in growth, right? And that's really where things started to change. I'll have the links for all these down below if you want to check them out for yourself. But by no means do they expect a full-on market crash. We'll get into that here in a second. But essentially, these are the bullet points. Zillow expects an annual home value growth to begin a gradual cool down. Keyword cool down. Now, I get during a investor meeting, they're not going to spook the whole market and try to get their stock to just massively drop. You don't want to do that, right? So they're going to be careful with the words and exactly how they say it. But they forecast 14.9% growth over the next 12 months, which was a drop. I believe it was at 16.5 previously. And then that is just a two months change, just so you know. They went from 16.5 to 14.9 in just 2 months. That's a really key thing to know. 6.09 million existing home sales are expected in 2022, according to our latest forecast. That's a 0.5% decrease from 2021. So they're seeing slowdown. Now, I want to highlight this as well. The slowdown that you're going to be seeing here is also because of overall supply. So not only are they, getting less homes sold, but you need to understand there's less homes in America to sell right now. A statistic back from 2020 is there were more houses being sold than there were agents in the United States, which was a kind of extraordinary statistic to think about, but that's how it was happening, and we're at this kind of a boom. Now you can keep reading, going over their overall statements, overall growth, and you can also see too the forecast from February with right here, this yellow line, and how it's decreased here. It's still well above. However, you can see it starting to drop gradually since 2020. Now, what's going on here? Now, this is where things get interesting, and you have people really concerned about the housing market crash. This is a relatively new article as well, posted today. Now, this is where we get exciting. Now, this is something people need to understand. You are not in the 2007 market. This is just all for hype. That's all this is. You're not in the 2007 bubble. What does that mean? They're not letting people buy houses they can't afford. That is not happening right now. I do believe people are stretching their budgets out and they're spending a little bit more than they should, and they're not valuing in everything that's happening. And I do believe a lot of the market is overvalued, but the prices in homes aren't going to drop drastically. Now, just to go over this a little bit and then give you kind of food for thought behind this. Housing economists are once again on high alert. The pandemic's housing boom has seen home price growth far outpace income growth. This is a very important statistic to understand because, yes, home prices over the United States are up 20% roughly. Here in Texas, they're up almost 50% just over the whole statewide growth and actual prices being listed. The private sector wages are up only about 4.8%. That's on the national level. If you look at minimum wage, it's moving up in some states, but it's just not that high to justify a 20% national increase in home prices. Now, historically, a hot job market cannot keep up with the historically hot housing market. This is also very important to know. We're going to jump around and look at this article here in a second regarding jobs, but this is another key statement here as well. You're hitting one of the best job markets historically of all time. The question is how much more can it withstand and how much longer can it stay up here? You're already seeing from our Fed and our government stating the jobs are as best as it's ever been, but it's looking like you're at the ceiling. It's not like you can get this many more jobs, right? That's a very important thing to understand. So you're hitting this area where inflation is here. Inflation is setting up. Prices are going crazy on homes. Jobs are looking decent. They are looking positive. However, the issue is can the jobs stick in with this market? So that's the disconnect right now. That's the problem. The disconnect between home price growth and income growth has seen us reach affordability levels not seen since the last housing bubble. That's the disconnect right now. But what I will say is if you look at the key thing that happened back with this housing bubble, it came back to the ARMs, which if you look at the average credit percent of someone getting an ARM, which that's the issue and could cause a potential crash, those people actually have like about a 700 to 720 credit score. So the concern really isn't there. I'm going to get to the concern here in a second, but that's not really the main concern based on credit. Now, as we look at this map as well, I want to highlight the key areas that are overpriced. And you get in here and you can see the red represents overpriced. It's really surprising that you're seeing New York. Some areas in New York, yes, are getting there, but you're seeing really California and New York aren't red hot. Now you have the southern parts of, yes, that they're always going to be pretty much red hot, but you come to Florida, to Texas, and you start to see the South is getting pretty hot, pretty overvalued based on some of these standards. Almost all Louisiana going into Alabama, you're starting to see that really hit all these coastline areas. And what you're really going to realize here, and this is the problem, it's all these coastline areas in Texas, southern Louisiana, going all the way to Alabama, Florida right here. And guess what all this represents to me? This is me personally. And this rides all the way back up towards, New York, Maine, and everything like that. All these coastline areas. This represents investors. That's the issue here. And that's who I think is going to be in trouble, for my personal opinion. I think that if you're looking at the market, if you're your average everyday American going to buy a home, you're not going to get kicked out of your house most likely. I think you're going to be pretty stable over the next few months. You're going to be fine. It's going to be very hard to evict a majority of America from their homes, and people have jobs right now and they can afford what they're doing. I get it. You're overpaying, you're pinching pennies, your savings is at all-time lows. However, I don't think that's the major issue. I also don't think real estate market, the price of these homes are going to drastically drop. If you look in the center of most of these states where homeowners are living, the main parts of where homeowners are living, whether it be land, whatever it may be, except with the exception of roughly, Virginia all the way to New Jersey, New York area right there. Everywhere else, and Florida, is looking pretty much fine. But it's all these coastline investment property opportunities. And these investors are the concern, because if you look at what's happening with our state taxes on property taxes, that's the issue. Those numbers are not flawed. Those numbers are going to be an issue. You're seeing that the real estate research firm finds that 65% of the housing market is overvalued. Okay, now coming to this, when the price of said areas are increasing 50% like here in Texas, those investment properties, the property tax is going to nearly double, specifically here in Florida as well. These are the areas I'm familiar with. Now, when you get up here, I assume it's going to get outstanding as well, specifically when you have a state that's almost all red. Like Florida here, it's almost all going to be investor type properties, a lot of what's happening here. And look at how much it's going. You're seeing a lot of out-of-state buyers coming in here as well, like you are seeing with Texas, like in the Austin areas. That's a very important understanding area. Houston, it's blowing up a little bit. That's where I'm located. But I would say Austin and these areas up here are really blowing up, because that's where a lot of these businesses and tech startups are going. If they're coming to Texas, they're not moving towards Houston. That's always going to be oil and gas and shipping and things like that. That's why that's happening, and that's the understanding, in my opinion, how this is moving. Now, going to mortgage rates, what's happening here? I also want to highlight that you have not seen this big of a leg up from the 3% level beginning of the year all the way up to around 548 over the past week is where we hit, and now we're kind of dipping back down. You have not seen this type of jump since back in 1993. You saw a little bit of this in 98, and the last time we bet maybe back in 03, 2013, but I still, you didn't even see this go on in 06. 06 levels, you actually stayed pretty stagnant at around 6%, 6 to 6.6%. You can see we are going quick right now. And what do we know as well? You're going to get more rate hikes from the Fed, and this is going to continue to hurt what's happening. Now, with the Fed, could they continue to spike rates? Could they continue to hurt the economy even more and make home rates go up even more, which affects those ARMs, which comes back down to some of these investors? Could they start hurting them? And that's where I think the issue lies. That's where I think things start to get pretty bad. Now, if you look at how the Fed is going over this, this is the only area of the market that they can really spotlight and say has residual strength. Economists expect a strong labor market recovery encourages Federal Reserve officials to be more aggressively towards raising interest rates in their fight against inflation. Now, there is no more buildup on jobs. There's no more going up. There's no more spiking. There's no key growth areas. Fed Powell, in charge of the Fed, he has already said. He called the labor market robust, a bright spot for the economy as he instituted the largest interest rate hike of 0.5% in 22 years. And he also said that this will continue to happen most likely for the next 2 meetings. However, even if jobs drop, even if they start to drop, they're going to be forced to even raise those rates higher to try to get risk down lower on those inflation numbers. Recession risks are now low, which is what they continue to say, but they also said inflation was topped off, which you can see inflation continues to rise as well, but elevated in 2023 as inflation could force the Fed to hike until it hurts. This is the key statement area as well. They're saying basically if inflation doesn't slow down by 2023, they're going to continue with these high rates, which would ultimately make the economy most likely lead into a recession, which would lead to a full-on crash. If you've seen the market already, you're already getting somewhat of a crash as we speak, dropping almost 1,000 to 2,000 points on the Nasdaq and then about 100 points on the S&P. These are all big concerns that people aren't really highlighting, and they're trying to say that you're fine, and they're trying to brush this off. So this is the key area that people need to be concerned about. And then before I let you out of here, FAU University did do a study on this as well, and they found that 0% of the housing market was overpriced about 2 years ago. Now you're looking at the market and 65% of it is overpriced by at least 30%. The last time we saw this was the implosion back in 2008. But I do want to highlight going into this that I don't think a full-on market crash on the housing market specifically is going to happen. I do agree with this statement though. Over the coming years, Zandy of Fortune magazine thinks that US home prices will be flat, which I agree with. As you're seeing inflation persist, it only makes sense that homes prices go up as well. That makes sense. I anticipate a very big slowdown in buyers and people coming into the market. You're going to see millennials and Gen Z almost have the inability to even buy homes over the coming weeks and months and overall years because of what's happening right now. And people are going to want to wait for a cool off on the housing market. For instance, everyone's coming up and asking me, Tyler, what stock should I be buying as they see on the news as the stock market is getting hit? No one's trying to buy into stocks at the all-time highs, or no one thinking it's a great idea. Maybe you're getting FOMO and you're trying to rush in and make a quick buck, but you're not looking as an investment opportunity. I'm having a lot of the older individuals that I know coming to me asking me for those opinions and overall market ideas. But looking right now at the housing market, you're very inflated, and I can see all the reasons for why you want to take a step back and just wait for it to cool down. He says that the most overvalued regional housing markets could see home prices dips of around 5 to 10%, which if you look overall on the move that we've seen over the past year and a half to 2 years, 5 to 10% is nothing. That is not a crash, and that would just be a slight pullback to people trying to adjust their prices on homes so they could try to get a sell. Because again, what we anticipate is going to be a slowdown in the market. Just buyers not showing up. It's going to be a lot more sellers, and there's actually going to be supply where buyers are going to be looking to get a better deal. And if, as you can look right now, the most overpriced markets are Boise, 73%, Sherman, Texas, 60%. You have 59% in Michigan, Florida, 57%, Tennessee, 57%. The biggest shock here is that a majority of these are down south. That's the very big shock in what you're seeing happening right now. And so I don't see a full-on market crash, home prices going down drastically. I agree with this statement, 5 to 10%, it makes sense. Investors are the ones that are going to be hurting when it comes to foreclosures and not being able to finish products and finish those projects. That's the concern for me personally, and that's where I think the opportunity will be.